If your New Year's resolution is to start investing, then this is the video for you. If it's not, then still watch this video because it might change your mind. Cha-ching! What's up everyone? Welcome back to another video with the Millennial Finance. Happy 2022. 2021 felt like it went by super fast, but we're going into the new year. So today, I thought to kick off the new year, I'll be making a video about investing 101. So basically, if you're completely new to investing your money and you don't know how, then this is the perfect video for you. To do this today, I'll be going through my slides so that you guys get a better picture of what I'm talking about. Let's get started. So before we start everything, I'm just going to address the elephant in the room is that a lot of people have this question, why should I invest my money? Isn't it risky? Well, to be honest, even I faced these questions when I just started out. My parents, they told me that you shouldn't invest based on their experiences. It's just a loss-making venture and it's like gambling your money. Well, that isn't really true. Let me just show you what happens if you don't invest. You all know that inflation eats away at the value of our money. I made a video about this. If you guys want to check it out, then you can go ahead and click it. So let me show you how inflation impacts our money. Let's say this year I have 1 million ringgit, it's 2022 in cash and I don't want to invest this money, I don't want to put it in a bank, I'm going to keep it under my pillow. By year 10, the value of this 1 million ringgit will only be 833,000 ringgit and 748. This is because inflation, which I assumed at 2%, has eaten away at the value of our 1 million ringgit. At year 20, we're only left with 681,000 ringgit. So if today I could buy a 1 million ringgit house with this money, 20 years down the road, my 1 million ringgit could only buy a house worth 680,000 ringgit today. So that is the impact of inflation. For as long as your money is not working for you, trust me, the value of this money will go down just like this. If you think about it, what if there's no inflation? Okay, let's say there's no inflation. There is an opportunity cost if you don't invest your money. Let's say there are two people, Edley, my brother, and myself, Emir. My brother is a saver, for example, and he just wants to save his money. He's going to put it into a bank account or put it into a piggy bank, whereas I am an investor. And with this assumption, we're starting off with 10,000 ringgit and we'll both put an additional 10,000 ringgit every single year for the next 20 years. By year 10, my brother, 10,000 ringgit per year. For 10 years, he will have 100,000 ringgit. And by year 20, he will have 200,000 ringgit. Pretty straightforward. For me though, since I invest my money every single month, every single year that I put more in, and I get a return of 6%, by the end of year 10, I will have 131,000 ringgit. And by the end of year 20, I will have 378,000 ringgit. This is quite a bit more. I nearly doubled my money compared to my brother just because I invested and he did not. Of course, things are not so perfect. The stock market may not go up, but it has been historically. So looking at these two graphs over here, first of all, the impacts of inflation on our cash if we don't invest it. And the second thing is that even if there's no inflation, investing your money can still yield you better returns in the future. So I would say that yes, investing is risky, but not investing is even riskier. So now that we've gotten that out of the way, let's get into how to actually invest your money. First off, I'll talk about the asset classes that you can invest in. The first one being the one that is the most common, the most popular, and where I have most of my money, it is in equities or stocks. Equities represent an ownership in a company. Basically, you can buy shares of an individual company, companies like Facebook, Apple, Amazon, Netflix, Google. If you want something from China, maybe Alibaba, or if you want something from Malaysia, companies like Maybank. So Maybank, for example, is a public company. They are owned by certain people, and if we buy shares of Maybank, even if it was just 100 shares, we still have a partial ownership of this company and the future profits. And that is how stock investing works. So people like to diversify their portfolios. I can't just put, all my money into just Maybank, right? That would be a bit irresponsible. So maybe I want to diversify it. I want some of my money in Nestle, I want some of my money in Chinese stocks like Alibaba, and a lot of my money in the US stocks like Apple. So if I want to do this, what I then do is that I invest into an ETF. An ETF is basically a basket of stocks that represent a certain thing. The most popular one is called the S&P 500 under the ticker symbol SPY. This is basically the 500 most largest companies in the US, and basically it will just keep updating itself. If a company starts becoming smaller, it will get removed from this list and the new companies will come in place. This is the most popular investing ETF, and a lot of people, who don't really care about investing, they just throw their money into this ETF. If you're a bit more adventurous or you have certain themes in mind that you enjoy, you can also go for other ETFs like the clean energy, emerging markets, and a lot other more. The reason why you do this is, for example, I believe in clean energy. I think that it is the future, but I don't know which company is actually going to be the largest one. So instead of buying or doing research and buying a certain stock, I just put it into a clean energy ETF. Maybe it holds 100 different stocks. And if clean energy actually is the future, I will reap the rewards. And even when you want to invest your money in stocks, you still have to decide whether you want to go for a more growth-oriented one or a more dividend-oriented strategy. This will all depend on your risk appetite and what your investment goals are. However, the overarching goal of investing in equities is to get capital appreciation and or dividends. You can also see on the right here that I have put risk and potential returns. So for stocks, I would say that it's medium to high risk depending on what you invest your money in, and then potential returns is high. So why I say risk is medium to high is because if you invest in a company like, let's say, Coca-Cola or Procter & Gamble, these are very stable companies and we shouldn't see a lot of volatility. However, if you put your money in something like Tesla, then we know that it is very volatile and it is a high risk environment. A lot of people invest their money here. In fact, nearly my entire portfolio is in stocks. It gives very good returns. You can choose individual stocks, but I do recommend ETFs. The next asset class is bonds. And what a bond is, it's essentially, think of it as a loan to a government or companies. Usually people don't buy individual bonds, so it's mostly done through ETFs as well, where the most popular one is called the US Aggregate Bond ETF. This basically holds bonds to the government, the treasury, and different municipals within the US. There are also the total bond market, so not just US, internationally. And then there are corporate bonds, which is like giving a loan to a company. The objective of bonds is slightly different than stocks. It's to diversify risks, preserve capital, and generate more income. So the risk of bonds, I would say, is low, especially if you go for government bonds. Corporate bonds can be riskier if you go for junk bonds, but I will consider it as a whole as low and potential returns to be low as well. Next up, we have commodities. So commodities are a basic good that's usually a natural good. I guess the most popular one will have to be gold. A lot of people invest in gold, whether they just buy it physically or they do it through an app like Hello Gold. That is a good example of a commodity. However, there are also ETFs for commodities, so gold ETFs, agriculture, uranium, oil and gas. I did mention in a recent video that commodities have done very well this year, and it is because its objective is an inflation hedge, and 2021's headline has been inflation. So things like coffee, wheat, sugar, they've all seen their prices skyrocket in 2021, and you can see that it is doing its job as an inflation hedge. A lot of people see commodities as one of the best investments because it's an actual good. You're not owning a share of a company. You're owning physical stuff like cotton, which is really needed for day-to-day life. Risk tolerance for commodity is actually high. They fluctuate a lot in price. And the thing is, there are a lot of factors that you cannot control or you're unaware of. For example, oil and gas, decisions by OPEC can determine the price of oil, and it's not something that you would know, which could lead to big volatility in price, which is why the risk level for this is high, but the potential returns is very high as well. This year again is proof. Oil is up nearly 100%. Things like coffee is up over 150%. If that is not high returns, then I don't know what is. Next up, we have another safe option, and it is money market funds. Money market funds are essentially a mutual fund that invests in liquid short-term instruments like fixed deposits. The objective of this is very simple. It is inflation protection and to preserve your capital. In terms of risk, it is very low, and in terms of returns, it is low. Final one that I'll be talking about is, of course, crypto. This is one of the newest asset classes, and it is a digital currency used to verify and record transactions maintained by a decentralized system. So because it is new, there are no real ETFs currently. Even the ones I recently made videos on, it's just a Bitcoin ETF. It's not really a crypto ETF. So you would have to choose individual cryptos in this space. Examples of the very popular ones are Bitcoin, Ethereum, Solana, and Cardano. The objective of this, some of you may not agree, but it is speculation and or capital appreciation. The risk level of this, of course, is very high. 10% drops are considered the norm for crypto, so do expect that. But the potential returns are also incredibly high. So these are the 5 asset classes that I'll be talking about. There are other asset classes, of course, like real estate, but I wouldn't really put this into this video today. So taking a look at these 5 asset classes, now you got to think, how are you going to build your portfolio to cover all 5? Because at the end of the day, what we want is a diversified portfolio. So how do you do that? There are many examples by popular investors from before. So Ray Dalio, he is a very good investor from before, and he's very well known for his all-weather portfolio. Basically, what it means is that in whatever economic condition, whether we're in a bull market, a bear market, recession, or the industry is booming, his portfolio will do well, which is why it's called all-weather. How he does it is he recommends 30% in stocks, 55% in fixed income, which is essentially bonds and money market funds, and 15% in commodities. Another popular one is the standard 60-40 portfolio split, which means 60% in equities, 40% in bonds, and nothing else. So this one, a lot of people use, a lot of people on Reddit I see using this. However, there's a more updated version where people just say, take 100, minus that by your age, and that should be the percentage of allocation towards equities in your portfolio. So for example, I'm 25 years old, 100 minus 25 is 75, so I should have 75% in stocks, 25% in bonds. This is a very traditional approach to building a portfolio. To be honest, I don't use either of these approaches. I do think they can be a bit outdated. But again, if you are a new investor and you're too lazy to think too much, then this is actually a good sort of foundation for you to start. If you don't want to follow these options though, there are other options to build a diversified portfolio with multiple asset classes. The first option is of course DIY. This is my preferred method. I love investing and mix and matching my portfolio. So DIY method is you build your portfolio with a mixture of assets depending on your risk appetite and your investment goals. The thing about this is that it will definitely take time. Because you're doing it yourself, there is no free lunch, but it also has the highest potential return. The second option is that you can go for an investment advisor. You can consult them to invest your money and they will help set everything up. The thing about this is it will cost you money. They will charge a percentage as a fee and you need to find a good one. I have never even considered this before, so I have no idea how much it costs and I have no idea who is a good investment advisor and who is not. So if you want to do this, then do your own due diligence. Make sure it's worth your money. The third option is to just buy a mutual fund. So there are a lot of mutual funds out there that are diversified. You just got to look for them. If you go through PRS and all that, there are already ones that will say I invest X% of my money in stocks, X% in bonds, and X% in commodities. Just like that, you already have a diversified portfolio just by buying that mutual fund, and you just trust those mutual fund managers to do the job for you. They will give you stable returns, but you need to choose the right fund managers and the right funds as well. So this one still requires a bit of due diligence. You got to go through the fund fact sheet. I will make a video about doing that in the future. But yeah, this is a very solid option and it's a way that many people actually invest in Malaysia. So if you've heard of things like public mutual and public mutual agents, those are mutual funds. The fourth and final option is through robo-advisors, which is the new thing in the market. Robo-advisors have a diversified range of asset classes. So they will give you stable returns, hands-off approach, and the fees are relatively low, but you are dependent on the robo-advisor and their algorithm depending on who you choose. So for example, if I choose StashAway, immediately I can get access to stocks, I'll get access to bonds, I'll get access to REITs, commodities, and to a certain extent, even crypto, which StashAway just introduced. So again, similar to mutual funds, just put your money there. In fact, this is a bit easier. Just set your risk level and it will do all the investing for you. And for this reason, I always recommend new investors to start off with robo-advisors. However, as you get more and more money and if you're more interested in investing, then you may want to graduate into something more DIY. So when talking about this, I also have a tip. Younger investors usually take on more risk because they want to grow their capital. At this point, for example, people like me, we don't have as much money, so we're willing to take risks. We want to grow money and we have 20, 30 years in the market. Even if there's a bear market for 5, 10 years, it doesn't really impact me. However, if you are an older investor nearing retirement, then you may not want to risk so much of your money and you want to preserve capital. If I was 60 years old, I'm going to retire this year, a 5-year bear market will impact me because I need this money now. So that is a clear differentiator that you need to consider when building out your portfolio. So I've talked about the different ways to build a diversified portfolio, but how do you actually invest your money and what are the platforms that you will need to use? So if you want international stocks, bonds, commodities, or even mutual funds, you can use Interactive Brokers. They cover many different countries, the biggest one of course being the US. I use this for my long-term portfolio, and if you want to know how to use the Interactive Brokers platform, we also have a video on that. If you want something closer to home, if you want Malaysian stocks and ETFs, then there is Rakuten. Again, if you want to know how to use the platform, we have a video on that. If you want mutual funds instead, a lot of people, you may even have heard from friends to buy public mutual. I don't really recommend that because the sales fees are rather high. I would say go for something like Fund Supermart. They have so many mutual funds there for you to choose from, and the sales fees are much lower. If you want to start off with robo-advisors, then there are a few choices in Malaysia. There's StashAway, Wahid, Rais, and MyTheo, and a few other more. If you want to watch our reviews, what we think about these platforms, we also have videos on those. And finally, if you want some crypto, then you can use Luno, which we also use for our own Bitcoin and Ethereum investing. I know a lot of young people would like to have a lot of their money in crypto. Personally, I have said that I will not have more than 3 to 5% of my entire portfolio. It is a very exciting thing, but it is still unproven, and I wouldn't really recommend risking so much of your money in something like Dogecoin. Also, I wanted to talk about when do you get returns. A lot of people ask me, when am I going to get money for investing in Apple? And this is something that I really need to explain properly. There are two ways to get money when you invest from stocks. The first one is through capital distribution, which is dividends or interest. So for example, I invested in TNB, Tenaga Nasional. I have one lot of 100 shares, and this quarter they're going to pay me dividends of 22 cents per share, which times 100 shares is 22 ringgit. So that is a choice by TNB. They want to give me the money, which is why I got this 22 ringgit, and I'm well on my way to my Lamborghini. So that's the first option. A lot of people are familiar with this. Amanah Saham, EPF, they all follow a similar structure. But the second way to make money is through capital appreciation. So this, especially if you invest in stocks like Apple, Google, Facebook, they don't pay a lot of dividends because they are still in their growing stage. So how you will make money is capital appreciation. So let's say looking at this ETF here, Cyber, which is a cybersecurity ETF, I bought it at $49.45. Currently, it is $52.39, which means I have an unrealized P&L, which is profit and loss, of $44. So this is my unrealized profits. The reason it's called unrealized profits is because this is the price in the market right now, but I haven't sold it, which means I haven't locked in these profits. If you want to lock in these profits, you'll have to sell all 14.4 shares before you realize the gains. So that is the major way that I will make money from stocks. If you're talking about investing in stuff like the S&P 500 even, most of the money that you will make is through capital appreciation. So don't expect them to pay you a dividend. Don't expect money to go into your bank account every single quarter or every single year. The value of your investment will just go up. Think of it similar to buying a house. Your house value can go up, but it's not going to pay you money, right? Only when you sell your house at a higher value, then you realize you make a profit. That is exactly how most of stock investing works. The same can be said about mutual funds, robo-advisors, and even crypto. So yeah, nail this into your heads. This is very good advice for beginners especially. Finally, before I wrap things up, there are a few things that you need to consider before you start investing. First of all, how much money are you going to start with? If you have less money, that's completely fine. Again, consider robo-advisors or money market funds because they have very low entry requirements. We do have videos about how to invest your money with 100 ringgit or even 1000 ringgit. We have 2 separate videos on that, so do check them out. Thanks to technological advances, we can actually invest our money with just 10 ringgit, where 20 years ago, this was not a possibility. The second thing that you need to consider is what's your risk appetite. So like I said, usually younger investors, you should be more risk-taking. Don't be afraid of your portfolio dropping in price. But if you can't imagine, for example, losing more than 30% of your invested funds, then look for safer options or have a more diversified portfolio tilted towards risk averseness, for example, in bonds or money market funds. For me, for example, I have a very high risk appetite, so I put nearly all my money into stocks. At times, it can lose 20-30% in value, but I don't really mind. I can sleep well at night. But this is an individual thing and no one's going to judge you for having a safer portfolio when you're young. End of the day, investing your money is better than not. The final thing that you need to consider is how much time do you want to spend on managing your investments. So Unless you enjoy the investing process and want to put a lot of time into it, choose a passive option so that it is easier for you to manage your portfolio. So things like mutual funds, ETFs, robo-advisors, these are great options if you don't really care for investing and just want a passive way to invest your money. If you want a more active way like myself, then you can check out individual stocks and all those stuff and start investing your money into them. However, you will have to track these companies because, there's no free lunch for investing. In fact, if you want to know how I did in 2021, I just came out a video about my investing lessons from 2021. Spoiler alert, I did very poorly, but yeah, do check that out. Hopefully this covers the very basics. I know there'll still be a lot of questions like what stocks do I invest in, which ETFs do I buy? To be honest, these are things that you just have to answer yourself. Again, choosing an ETF like the S&P 500 is much easier than choosing an individual company to invest your money in. So if you can't decide, just invest in ETFs. If you guys still have any questions, feel free to comment down below. Or if you want to sign up with any of the platforms I mentioned earlier, use our links and our codes. We'll leave it down in the description below. You can get some free trades, some free money from some of these brokers as well. So thanks for watching this video to the end, guys. Hopefully 2022 will be awesome for all of us. Give us a huge thumbs up if you like this video and subscribe to our channel. See you guys in the next one. Peace out.